You're about to hear my conversation with Michael Kapler, Vice President, Portfolio Manager at Mackenzie Investments. In today's episode, we're diving into the world of systematic investing, what it really means, how it's evolved from the early smart beta days, and how investors can apply precision and discipline to capture new opportunities in different market environments. We'll explore how systematic strategies have grown more sophisticated, what they can add to portfolios in today's market regime, and how products like high dividend yield ETFs using covered calls and leverage are changing the income landscape. This podcast is for informational purposes only. Information relating to investment approaches or individual investments should not be construed as advice or endorsement. Listeners should seek professional advice for their situation. Welcome to The Invested, a podcast from Mackenzie Investments. I'm your host, Prerna Matthews, Vice President of ETF Product Strategy. Systematic investing is all about bringing structure, repeatability, and data-driven insights to portfolio construction. But it's also a field that's evolved dramatically from early factor-based smart beta strategies to today's models that adapt to different market conditions with precision. To unpack this evolution, I'm joined by Michael Kapler, Vice President, Portfolio Manager at Mackenzie Investments. Michael, thank you for joining the podcast today.
Thank you. Glad to be here.
Well, you are certainly an expert in this space, Michael, so I am looking forward to our conversation today. And starting with the evolution of smart beta, when we look at the smart beta era, we've seen quite a lot of change over the decades in terms of how investment solutions have evolved for investors. Can you tell us more about how the smart beta concept emerged? What did those early smart beta ETFs and funds look like? What did they get right? And perhaps where do they fall short?
Let's first define smart beta before we dive into its evolution, because for different people it might mean different things. For us, smart beta is an index plus strategies that's simple, low cost, and most importantly, systematic. This is critical for a robust and repeatable investment process that we run. The main part of a strategy is a model that forecasts excess stock returns based on company properties. Well, back in 1960s, the model looked very different than it does right now. Back then, William Sharpe was working on a capital asset pricing model. This is a one-factor model that excess stock returns are forecasted by one variable, market sensitivity. At that point in time, it was simple and elegant, but naturally didn't capture all the stock properties. So in 1990s, Fama and French introduced size and value to the factor mix. And later on, practitioners added factors like momentum, quality, low volatility, investment, and other factors. So as time went on, what used to be a manager alpha or a skill now moved to what we call a systematically explore risk premium or smart beta.
Okay, that's a really helpful historical view to and a definition of what smart beta or systematic is. So, can you tell us more about that? Unpack that for us a little bit more around the advances in data and modeling, and as you've seen that evolve, as you mentioned, 1960, 1990, some key moments in time there as practitioners evolved this area of investment.
We saw a big explosion in that area as data and compute become more available. In terms of data, the practitioners and academics start exploring different factor definitions and doing case studies of a factor work across different geographies and across different market regimes. Also, as compute became available, the optimizer, a key part of a strategy, got improvement. The optimizer is a tool that allows you to translate your excess stock returns or market views to the portfolio weights. As compute become more available, the optimizer can handle bigger portfolios and can handle different constraints. Usually factors are low and sometimes negatively correlated, so we use the optimizer to take advantage of factor diversification. We try to maximize exposure to the factors that we like, and we try to minimize exposure to the factors we don't like. And that's why we prefer multi-factor portfolios.
Yeah, it's a good call out there in terms of just the computing power evolving over that time period that has actually helped portfolio managers like yourself, practitioners in this space, evolve the ability to optimize portfolios across different factors. We'll talk about that shortly, just that sort of play between different factors and the importance of multi-factor. But can we chat a little bit more about systematic strategies through different regimes? So, if we think about strong up markets, sideways markets, or stress periods, can you tell us more about how systematic strategies have evolved over time or how they help investors even today kind of navigate those different environments?
Absolutely. So let's take 2025 as an example. So this was an eventful year. It started with a lot of policy uncertainty, right? Tariffs, how would they impact the prices, right? So during that time, more defensive factors like low volatility and quality did well. And in the second part of the year, as that uncertainty kind of cleared and we had AI growth boost, the momentum and growth type strategies perform better. So if you think about uptrend, it's usually momentum growth, and during a market recovery, you have value participating and size being strong. And during sideways or stress markets, you have more defensive factors that work much better. Think about low volatility, quality, and also when the market goes down, the momentum initially can work, but it's really susceptible to sharp reversals. So during sharp reversals, momentum will underperform.
Yeah, I appreciate that view and a very simple framework of how to navigate some of those key factor exposures. So, if we now think about the income focused investor, we've got in Canada a lot of our listeners, our advisors who have clients or themselves clients with income needs, and so it's definitely a large and growing segment of Canadian investors. How might an income focused investor versus a total return seeker think about investing through different types of systematic strategies?
When I think about income type investor, I usually imagine a retiree who tries to supplement their income with stable cash flows. While I think about total return investor, it's probably somebody in accumulation stage, somebody in the middle of their career trying to making a good salary and trying to create that investment portfolio, putting money in. So they have very different objectives in terms of the end goal and stability of the solution. What's good about smart beta, it's a customizable approach. It's applicable to both type of investor. So for the income type investor, you would probably want a high dividend, stable cash flow type of portfolio with focus on downside, such that you invest in quality and low volatility factors, such that the money is taken out from portfolio, the portfolio is sustained and able to grow. While the total return investor, on the other hand, is focused more on a longer term risk adjusted returns and probably gonna favor multi-factor approach that gonna have value, momentum, quality, low volatility factor to create a long-term value add.
That's also a great reminder for our listeners is income doesn't have to come from just one type of portfolio, right? And it can be constructed in lots of different ways. Speaking of income, there's some work that you and the team have been doing over the last several months on some solutions now that Mackenzie has in market that are equity in nature, but income in focus. So let's talk a little bit more about those and walk us through the mechanics. So you've got some high dividend yield ETFs now. They're systematically built, they use covered calls, they use leverage. Talk to us more about how they work for someone who's new to the product, who has never heard of it before.
I'm glad you asked. So we launched two high dividend ETFs in September. One is buying high dividend companies in Canada, and our one is buying high dividend companies in United States. They build on the same systematic platform that has three main parts. So the main part is a smart beta high dividend strategy that invests primarily in stable high dividend companies that are able to pay their dividend and have defensive tilt of low volatility and quality. Second part is the option strategy. The objective there is to buy companies at attractive prices and sell them at full valuation. And the final piece is a leverage. So currently we target a 20% static leverage, and it is used to make sure that overall portfolio market exposure is at the same level as the index. Now, if we dive in a little bit more into the option strategy, it consists of two parts. We use cash covered put writing and covered call writing. The cash covered put writing is used to buy the companies at attractive levels, and cash covered call writing is used to sell the companies at a level that we think is a full fair valuation. Upfront, we don't know if these options going to be exercised and the money going to be taken out. So what we do while we wait, we collect the premiums. The key here that process is fully systematic. It's updated every month, and we able to adjust our expectation in terms of what is a full fair valuation and what is attractive price for that particular stock.
Thanks, Michael. So these products are a bit differentiated than what the marketplace has been used to. It's sort of more of the vanilla covered call ETFs, which have been quite popular over the past few years. There's no free lunch though in many of these products. Can you talk to us more about that trade-off that our listeners should be understanding, such as between upside participation and premium income or rate sensitivity and path dependency? Can you tell us more about that?
Yes, so when you write a covered call option, essentially you're agreeing to sell a company at a particular price. We usually determine that price where we see a full fair valuation for a particular company. But as you know, stocks and sometimes are irrational, right? Sometimes the stocks keeps running. So essentially, what can happen if a stock continue to be running, we sell some upside potential and do not participate the same level as the market. But we have a solution for that. As I mentioned, part of a strategy uses leverage. And we use leverage to make sure that overall market exposure of a portfolio is at the same level as our benchmark. On a downside, when you think about a market correction, we constructed our systematic smart beta strategy to be defensive. What I mean by that, we have a tilt to quality and low volatility factors that historically were able to add value. In terms of rate sensitivity, our solution is similar to other high dividend ETFs, which sometimes can be thought of as equity bond proxy. So essentially, it has an equity duration. What it means when rates go up, usually high dividend ETFs going to underperform the broad market, and when rates go down, they have much better time.
So you kind of answered my second question or my next question I should say, but not fully. So you've given us a sense of what this means compared to a traditional dividend fund, which you just spoke to. What about fixed income, like traditional fixed income funds? Where can these types of strategies fit in a portfolio alongside them? Are the risk factors the same or are they different? And how do investors or listeners think about that?
I want to highlight a few other differences if you compare our solution to a high dividend ETF. First is the cash flows. In a traditional high dividend ETF, the cash flows mostly come from a dividend. We have two sources of cash flows. One is from dividends, and one is the option premiums that comes from our option overlay. The second difference is in the construction of our smart beta strategy. We target low volatility and quality that an expectation would produce slightly more defensive portfolio. And finally, what sets us apart is a structure of option overlay. We try to buy companies at attractive levels and sell them at full valuation. So this is how would you see it versus a high dividend ETF? If we now look at a bond proxy, this is slightly different. So the portfolio has equity risk, and it makes it different than a typical bond proxy. But at the same time, that equity risk adds a growth potential for the portfolio. The tax treatment also makes our portfolios different than a typical bond proxy because the dividends are taxed at a preferred tax rate, and the premiums that we collect from option writing are taxed at a capital gain level.
That's a great call out. So income is income until you have to go pay the tax bill. And then that can look very different. So before we wrap up our conversation today, I'd love to get some more of your thoughts on the due diligence process around systematic strategies and income related strategies in the systematic space as well. But we continue to see lots of products, funds and ETFs come to market that are systematically oriented and certainly income focused, lots of those types of solutions. And not all are built the same, as you've just walked us through this. Are there any common pitfalls that you may have already mentioned or you may not have mentioned yet? Common pitfalls, warning signs that might indicate a product's process isn't as disciplined or robust as it seems?
Absolutely. When we looked at the income products, we definitely want to find what other sources of income and what other sources of risk you're taking. And you want to make sure that this is as clear and transparent as possible. So when we design our high dividend ETFs, we make sure that our smart beta process is defensive. It targets quality and low volatility. It has an option overlay to buy companies at attractive levels and sell them at full valuation, and you have a leverage to keep overall portfolio at the same level as a benchmark. On top of that, I would highly stress that team behind that process is very important. And at Mackenzie Multi-Asset Strategy team, we have roughly 20-person people with background in institutional money management and managing systematic strategies. In terms of red flags, when we look at due diligence for income products, we would look at inconsistent rebalancing, concentration in either a company or a sector or a factor, or abnormally high yield. All these questions have to be explained, and we're looking for something that is repeatable and transparent in terms of a process.
Okay, I love that. So, sources of income and sources of risk. Know where your income is coming from, know your team or the portfolio manager, and red flags you highlighted were inconsistent rebalancing, abnormally high yield, and some form of concentration, whether sector, security, things to watch out for. That's wonderful. And to close out our conversation today, for our listeners who may be asset allocators, who may be investors, and looking at just generally systematic strategies beyond income, what's one guiding principle you could potentially leave our listeners with who want to harness systematic investing without losing that sight of risk and consistency within their portfolio?
So when you look for income time products, there is maybe a tendency to just sort them by yield and pick the top one. And I think that might be a really bad idea. So I would really focus on the process behind the product. Make sure it is transparent, repeatable, robust, that there is a strong team behind that has experience managing that products. And that's what we did, for example, for our high dividend ETFs. We run similar strategies for different funds we manage. So what we did in September, we just packaged that strategies in one convenient package. So one key takeaway, instead of just focusing on the yield, just buy a robust, repeatable process.
Michael, thank you for walking us through how systematic investing has evolved from smart beta to today's precision driven adaptive strategies. As you've heard, systematic investing isn't about replacing judgment, it's about refining it. With data informed models, disciplined processes, and clear objectives, advisors can bring more structure and opportunities to their portfolios. That brings us to the end of this episode of The Invested. To our listeners, thank you for tuning in. If there's a topic you'd like us to explore in a future episode, please reach out through our blog or find us on LinkedIn. Until next time, stay invested. The content of this podcast, including facts, views, opinions, and recommendations, is not to be used or construed as investment advice and is not an offer or an invitation to buy or sell any security. The content of this podcast should not be relied upon for any purposes, and Mackenzie Financial Corporation is not responsible for any reliance upon it. This podcast includes forward-looking information that reflects our current expectations or forecasts of future events. Forward-looking information is subject to risks, uncertainties, and assumptions that could cause actual results to differ materially from those expressed herein. Our views are subject to change based on market conditions. Commissions, trailing commissions, management fees, and expenses may all be associated with mutual fund investments and exchange-traded funds. Please read the fund facts and prospectus before investing. The indicated rates of returns are historical annual compounded total returns, including changes to unit values and reinvestment of all dividends or distributions, and does not take into account sales, redemptions, distribution, or optional charges or income tax payable by any security holder that would have reduced returns.